Hi, I'm Mark from Property Ventures. Welcome to this week's New Zealand Property Podcast, where we interview the property expert around New Zealand. Hi, and welcome back to the New Zealand Property Podcast and video series, and welcome back to Kris Pedersen from Kris Pedersen Mortgages.
Good afternoon.
Good to have you back, and it's an exciting day for people like you into finance because it's the 28th of November and the Reserve Bank have just come out with some new changes, including changes in LVRs. So there'll be people watching this, especially investors, that'll be pretty happy. So we'll start off by tell us what the initial changes are.
So a bit of relaxing for both the first home buyer market and for investors. Firstly, on the first home buyer market, we take a trip back to 2013 when the LVR restrictions first got announced. The level was put in that a maximum of 10% of banks' total funding could be done on LVRs above 80%. It was relaxed January 1 this year up to 15, and we've seen a further relaxing today of up to 20% of total lending. So that's pretty good for those kind of young people in particular who are trying to actually make that first step on the housing market. The big one especially, I know that a lot of you who are listening are investors, and the way they've worded it is a bit complicated, but we've basically seen it relax from 65 to 70%. If you read the actual description from the Reserve Bank, they make it sound like there's this 5% exemption that the banks can do also above the 70% threshold. That was part of the rule change at the start of this year, and they don't actually do that. So best thing to understand is that we've really gone from 65 to 70%. So that will be kind of good for some of you who maybe just need that little bit more access to equity to get back in the market. Yeah, and some will say it's not too much of a change, but compared to a year and a half ago when it was 40%, that's quite a big change on a $100 million property. So that's first home buyers and investors. Just to confirm, we're pushing obviously Property Ventures new builds quite a lot, and we will be at the start of next year. The same rules remain there, 20% still? Yeah, so there's been no tightening on anything that was announced today. Any other exemptions? There have been exemptions, I suppose, to these LVR rules, which have been in place for quite a while. So new builds stay exempt, dollar for dollar refis are still exempt. It's just an improvement on what we basically had. Do note that while this was announced today, the Reserve Bank has said it was to get implemented on the 1st of January. What we did see last year is the banks took a little while to actually kind of come in with the rule changes. So just be wary for those of you prior to Christmas. You may be waiting until kind of maybe mid-January before you actually can get the benefit of it.
Oh, so I was holding off coming to see you, Kris, for a property right now, and you mean I can't get 30% already?
It's hard to know because I suppose the banks have gone through it for the first time. About 12 months ago, they may be a whole lot faster to act. We've just got to wait and see. We've had no communications yet from any of the main banks today that they've already, ready to make a move. We will wait with bated breath over the next week or two.
So the official date you said was what, 1 January?
Official date's 1 January.
Okay, so started.
So keep in mind that just the way the banks work is even if they come out and say we're ready to go on the 1st of Jan, they tend to be a little bit useless in regards to stuff and are unlikely to make approvals. Even if settlement's happening afterwards. So you're probably going to, I think, still have to wait for the 1st of Jan to go past before we can actually get that approval in place. Okay, so you're expecting obviously a few people coming in early January after they're refreshed and decided they're going to buy a whole lot more property and New Year's resolutions,
which I'll talk about in a moment. But on the refinance, so how's that going to affect the refinance? There'll be people out there going, should have got a $2 million portfolio, I've just made myself quick maths, maybe $100,000 or $100,000.
The timing of this is really good for, I think, all investors. Something which is disconnected to this, but I think it's worth talking about, is at the moment we've actually been breaking a lot of people's mortgages and refixing. In a lot of cases, people have been managing to save a lot of money in doing so. So that might just be a straight break, go down to a lower rate. We've had quite a few two-year rates in that kind of 3.99% space. It's nice to see a 3 starting an interest rate. So that's been really beneficial. So we've been saving huge amounts of money for clients in doing that. What you may want to be doing with this change with the LVRs is looking at maybe breaking at the same time as maybe topping up to release deposits to maybe be able to get out there and get a new property. At the same time, you may be looking to make alterations to your existing portfolio so you can kind of keep moving forward. But I think it's a good way to maybe do the two at once. Look to improve your interest rates, improve your cash flow, and maybe look to kind of get your hands on some more equity to keep moving forward at the same time.
Yeah, stars are certainly all aligning up, aren't they?
Yeah.
They've never had interest rates like this, so I mean, I'm exactly the same situation, what you're saying to myself. We job got to do on a property, get it refinanced, get the 30% withdrawal, and all ready to go again, and get it along to 2-year, 4-year, whatever mortgages there are. Just on that, what's the can you get a? Sorry, I haven't looked. So some people out there will be more educated than me, sitting there right at the moment on this in the last few weeks. Can you anything under 4% for a two-year loan or
so
a
2 years we're seeing at 3.99. You got to do a bit with. We're getting that across most of the main banks at the moment. So you'll find your ANZ, BNZs, Westpacs, TSBs, who's obviously even one of the smaller banks are doing that type of rate. You'll get the 1 year slightly cheaper than that, but I'm a bit of a fan of the 2 year. You will find that then jumping up into the slightly longer terms, your 3s, your 4s, your 5s, you're starting to pay quite a big increase. So you're going up to around 4.3%, give or take, for a 3 year, then up another reasonable nudge for the 4 year rate. So we're definitely doing a lot around that 2 year rate at the moment, and that's what I've broken and refixed some of my personal mortgages on as well. Yeah,
no, 2 years good, because I mean, they never say it's going to go down anymore, but how much more can it go down? I think anyone will be happy with a 3.9 for 2 more years.
That's crazy. I remember saying that though when I think I had interest rates in the 5s and 6s and kind of saying that type of stuff. I never thought I'd be fixing here with a 3, so it's nice to see.
Yeah, no, absolutely. So what sort of what's the biggest problem right now that investors and home buyers are finding with finance? It's nice to be talking about LVRs today, but what's been the biggest headache in the last 6 months, when in the last year and a half or 2 years, banks have been the biggest problem with anything to do with property investing? Where are things at the moment with the banks? How relaxed have they been before this announcement today?
The biggest change has been around the debt servicing rules. So of course the two main components that banks look at when assessing someone is the equity or the deposit, the amount of equity or cash you're putting into maybe a deal, and then the way they actually assess the debt servicing side. And we've seen that side tighten up considerably over the last kind of 6, 12, 24 months. Firstly, banks tightened up the way they were looking at existing and new mortgage debt, working off high test rates. So we're sitting here talking about you can actually get a 2 year rate at 3.99, but the bank's test rates are pretty much double that. There's a large disparity between what you're paying and what you're getting tested at.
Yep.
And then there's this Royal Commission going into banking over in Australia at the moment, where there have been some naughty boys on that side of the Tasman and getting their hands smacked quite vigorously at the moment. And that's also meant that they're having to assess client serviceability more thoroughly than what they were maybe doing previously. And those combination of the higher test rate and the more detailed assessment has made the servicing side a lot harder. We've gone from clients who, say a year ago, we could maybe get another $1 or $2 million debt, to clients who literally can't borrow another dollar now. So that's quite significant changes.
Yeah.
What is flowing on from this overall tightening though is definitely a large increase in non-bank lending.
Right.
And so we've definitely gone from that probably being a relatively small proportion of our overall business to being a pretty large chunk at the moment. And again, with the LVR change that we've seen today, it's going to be interesting to see how the non-bank market kind of works with that, because relaxing in banks, criteria naturally eats into non-bank market share. Will they maybe follow with maybe some more loosening of their own to make sure they don't lose market share? That might be a possibility as well.
The those non-bank lenders you talked about, what sort of LVR were they charging up till today, sort of thing, in the last week? Well,
you've got a real mix. You've got what we'll call the prime non-bank lenders, who are actually, believe it or not, funded by the banks. So they actually have wholesale bank funding lines. These are the Resimax and Liberties of the world and stuff like that. And won't get too much into the criteria here, but you had them doing, in some cases, say 80% investment lending. So while the banks were back at 65, they were in some cases going up to up to 80%. And I know that had been an area that they were doing a lot. Obviously, the banks relaxing a bit into this will chew a bit into their market share as well.
Yep.
So it's going to be interesting to see if they have
probably still got enough fat maybe to...
Potentially, It'll just be interesting to see. I don't think you're going to suddenly see them going to 85 or 90, but they may have to make their products maybe a little bit more competitive in some ways to make sure their market share doesn't get eaten into too much.
And those lending industries you're just talking about, are they the interest rates depend on the individual. Is that correct, or are they standard?
You'll find that those particular lenders have pretty much set interest rates. They do vary. Resi-match interest rates are pretty competitive, but they are pretty strict in regards to their overall criteria. Liberty is slightly more relaxed, but higher interest rates. And then we go into a plethora of other kind of lenders who you're probably paying a little bit more on the interest rates, but you're finding funders who are looking to fill this overall market. And we're definitely seeing some of them look to attack that space I was referring to before, where banks are pretty much cut people out of the market because they can't meet the servicing rules.
Yep.
Some of these lenders are trying to kind of go into that so they can see an opportunity. At the moment, I wouldn't say we've got huge demand because the interest rate pricing is still probably scaring off most investors from having too much of an appetite, but I'm hoping that maybe going into 2019 we might see them kind of pull their pricing back a bit more and be able to provide some more solutions to the investor market.
Okay, great stuff. I'm just firing questions from all angles here. So
far away
at the moment. So I'm just wondering of late whether there's been a change or the reasons why the investors are choosing between a fixed, a floating, a 1, 2, 5 year, and what I'm getting at is I know you know a bit about property management. You also run a property management sort of business, and with the new rules and what have you coming in with they're talking about tenants having to sign up for 2 years, or landlords having to, all these sort of rules that they're throwing out there. Do you think that will then affect what investors are doing? What are the main reasons that the people at the moment are choosing between different rates? Is it purely the money side, the interest side of it?
Yeah, we personally don't find too many people discuss what's going on with, say, the tenant situation when fixing a rate. The only thing that may come into it, of course, is some people are thinking maybe of selling properties. And so suddenly, of course, if they're debating whether to put a property on the market in the next 12 months, they're not likely to want to take a 2, 3, 4 year rate and maybe incur some break fees. So that is definitely one of the areas where you might see someone maybe take a shorter term to fit in with their lifestyle.
Right.
Such similar things happen maybe when you've got people going on maternity leave, maybe people looking to change jobs and start a business. Sometimes they may time the fixed rates so they can alter the cash flow to work in with that change in life, if that makes sense.
Yep.
Most people, New Zealanders, do have a fascination with a 2 year rate. We've found, I remember BNZ for years, what they called their unbeatable campaign that was always marketed around that 2 year rate. And a lot of times people have tended to pick it without much common sense.
Yep.
I will say at the moment, just I think the way the stars are aligning it is probably the preferred rate I would be recommending.
What's the longest rate you can get at the moment in New Zealand? I mean, our interest rates are coming down, close to US rates. We're not that far from it.
TSB's got the longest, which is a 10-year fixed rate. I literally haven't fixed anyone on that.
Yeah.
I think for a year or two. Did have a client sometime last year who thought Armageddon was coming, and the Trump factor was going to drive us to interest rates that no one had ever seen before, and he was quite keen on grabbing some of that money. But
are you allowed to say what's the interest rate you can get for something like that?
I don't know what you get with a discount because we literally haven't had any demand for it, but I believe the carded rate is around 6.25 from memory, so I think you'd probably be looking maybe around that kind of 5.99 rate, give or take, which, if you look at historical interest rates, to get that kind of certainty is actually still quite fantastic.
Pretty good, yeah. I'm just thinking of people, will be plenty of people out there, like myself, I guess we're a trader.
Yep.
So if we want to buy and hold in another company, we really have to, have the intention of holding it, and if you had a 10-year fixed loan, you can't get any more intention than that.
Yeah.
With the risk, I guess, if something happens, that's the biggest risk.
The biggest risk is, obviously 10 years is a long time from sitting on this side of the desk. I can sit there and say I've had a huge amount of clients who have come in with the intention of not selling, life changes. And there's times where you will sell, whether it's a life change to buy a new property, anything like that. So you've got to be a bit wary going for that long.
Right. Okay, so we're sitting here on 28th of November, the changes have happened. What do you recommend people perhaps do before Christmas, before they come in, and then after? It's
a good time, I suppose, a year to start thinking about what 2019 looks like. Whether you're going to be sitting there just looking to, reduce some more debt over the next year or two, or you're going to be looking to add some more acquisitions. And I suppose for me, it's a number of factors. You go back to the interest rate discussion that I was having before. I'd just be recommending for everyone to have a look and see if they can benefit. We'll do what's called a break fee analysis, where we can show you the pros and cons from a cost point of view. There's no cost to you for us to do that analysis. You can then see if it's something you want to proceed with. At the same time, we have historically always recommended what we call a split bank strategy, where we've got your own home with maybe one bank away from your investment stock. And to me, it makes sense, if you're still carrying debt on your own home, use this LVR change to increase debt on the rental or rentals, and retire some debt on the personal side.
Yeah.
And at the moment, with this whole price situation that's going on, we're back with seeing banks throw some cashbacks and stuff around as well. So in some cases, it makes sense to try and access these good interest rates. You might be able to get some cashbacks. You might be able to top up to obviously either restructure or move forward with your investing. And you can do all of that type of stuff at the same time. So to me, I know we're going through this, it's a good thing maybe in that kind of January, February market to look to do that kind of restructure, get yourself really set up for a good 2019. And ideally, if you're wanting to add more acquisitions, slap a pre-approval in there, so you can kind of be out in the market looking for some of these opportunities. We definitely, Mark and I were having a bit of a chat before, and there's definitely some good buys on the scene at the moment, aren't there?
Absolutely are. So it's always, as I said, the stars are all aligning for the investors, which is quite good. Okay, that's fantastic, Kris. So, geez, my advice would be to go and refinance your investment properties and get all ready, and use Property Ventures to start buying your new build portfolio at 20% LVR at the start of next year.
Yep.
Don't know how you have to feel about that, but you don't have to comment.
Get into Property Ventures.
Get into Property Ventures, all good. And just see, hearing Kris speaking is exactly the reason why people, especially perhaps people who haven't bought a property before, and their own property or an investment property, is probably why you use a broker over a bank. He's just given so many stories in the short 15 minutes here about what banks do, what the non-bank lenders, what they offer, and if you just stick to one bank, you don't get that, and also you get the risk, as you said, of not splitting the banks between your own home and investment property.
Yeah.
So, well, good. Anything else, Kris, you want to inspire these people watching the video right now? Otherwise, we'll think about wrapping it up.
No, I'd just sit there and say, for those of you who are looking to go shopping, just reiterate what I said before. While I don't think, I suppose, focusing on the Auckland market, we're necessarily going to see some growth for a while. We're definitely seeing some big chunky discounts consistently for the first time in a long time. So, capital growth ain't the only way you can make money out of property. It's a good time to be out there.
Yeah, we're seeing a lot of sales, or both in fact, right now, just in the last 2 weeks, a lot of listings around the whole country come on board, but there are still, as you're saying, probably because there is that discount now, we're seeing a lot of investors buying right now too. So we're going through quite a good patch.
Yeah.
Probably because of that. So
long may it continue.
Absolutely, stick the LVRs with it, and the cheap interest rates, all good.
Definitely.
Okay, hey, thanks for your time, Kris.
Thank you, Mark.
Anyone wants to contact Kris, krispedersen.co.nz, is it?
That's the one. Yep.
That's the one, with ease, no O's.
Yes, thank
all
you.
Good. Hey, thanks for your time today, and we'll welcome you back soon.
Cheers, thank you.
Cheers.